The way that it typically works is that a cup and handle is a continuation pattern. The cup is the long base. In silver's case, from the early 1980s through the decades of the consolidation. The handle is the pullback, the tightening range, like 2011. So once prices break above the rim, that $50 price that we saw in 1980 and 2011, the price can go parabolic. And when you throw in the shortage, when you throw in the demand by the big money, when you throw in the demand by the BRICS countries, etc., I don't know, triple-digit silver isn't really so out of control. It's not out of line as far as I'm concerned. One last point I'd like to make about gold and silver. You know, it's interesting to me that, and in particular gold, because silver has yet to catch the same fire that silver has, that gold has caught. And, you know, we look back over the last half a year or so, and the S&P 500 in the last 5 months or so is up almost 1,700 points. That's one of the strongest rallies in history, right? Gold is up about almost 40%, about 39% when compared to the S&P's return over the last 5 months, which is one of the strongest returns ever. Gold is up since 2023. Gold's up 100%, the S&P is 67%, that's great. But just over the last 6 months, where everyone's focusing on NVIDIA and stuff, where it's up as big as it is, 1,650 points, gold's run is up 4 times the S&P's return just in the last 6 months. It's up 37% versus 9%. And so even amongst this AI boom, the biggest tech story since the internet, equities are still trailing gold, and yet nobody talks about it. So I remember when gold finally broke through $400. I couldn't believe it. It finally broke through $400 all those years ago. And if you would have told me that we are sitting at futures almost at $3,700 right now, and the media and no one understands it, to me, it's absolutely insanity. The big money understands it. And this is what I was talking about recently, where you have the largest exposure to stocks in the history of the stock market by mom and pop investor. You have the largest ever margin exposure, which is $1 trillion, and you have the largest exposure to options. So you have the public all in on stocks, all in on margin, and all in on speculation with options. At the same time, the investor, the big money, the insiders are leaving at a 7-to-1 clip, leaving the equity market and going where? I don't know. Maybe they're going to gold, as the biggest money in the United States is standing for billions and billions and billions and billions and billions, and I can keep on going every single month. Every single month we are seeing huge deliveries into COMEX, and why does nobody talk about it? So let's just paint the backdrop for a minute and talk about our wonderful mainstream media that lacks all journalistic integrity, period. The greatest boom ever in the S&P because of the AI revolution is trailing the price of gold and silver. The insiders are dumping equities and running to, we don't know, as the public is all in the stock market, not just all in, greater than at any time in history. In fact, not only are they in greater than any time in history, the valuation is at the highest point in history, greater than the 1929 crash, greater than the '08 crash, greater than the dot-com crash. And they're not just all in, they're all in on leverage and margin. And so with all of this metal coming into COMEX, both gold and silver, record amounts, net importers, record amounts, and the public not owning any, and it outperforming the S&P, where the hell is Fox News? Where the hell is this idiot Jim Cramer? Where the hell are all the people that are supposedly looking out for you and I found it interesting, in particular, that this guy, article from investing.com, I'm going to read it to you because Adam Lipinski again, and I don't know if you remember Glupinski, I talked a lot about him a year ago, and I'm going to read what I said about him a year ago after I read this. I want people to think big picture. This is coming from the head of the Polish National Bank, the central bank. This is from investing.com. Poland's central bank announces plans on Wednesday to increase its gold holdings to 30% of its reserve assets, aiming to strengthen the country's financial security. Glupinski says in these difficult times of global turmoil and the search for a new financial order, gold is the only safe investment for state reserves. NBP Governor Adam Lipinski said in an emailed statement. He is proposing a motion to the bank's management board about raising the reserve target for gold to 30% from their 22%. Now, remember, I said I was all over this in 2023, screaming about this. Let me read you what Adam Lipinski said in 2023. When asked, why does the central bank hold gold? Because it retains its value even if someone cuts off the power to the supply of the global financial system, which is based upon electronic accounting records. Of course, we do not assume that this will happen, but as the saying goes, fortune favors the prepared, and a central bank must be prepared for the most adverse circumstances. This is why gold has a special place in our currency management process. So he's basically saying, think about everything digital. When someone cuts the power to the financial system that is all based on electric accounting records, this is why we own gold. And now he's increasing it to 30%. When you look at the most well-informed traders in the world, forget about the wealthiest, we know that. They're the most well-informed traders. They drop crumbs, they give you clues. And so when we see a head of a central bank saying we're going to increase our holdings to 30%, instead of buying more treasuries, one that is aligned with the West, because we're very concerned, and if the power gets cut off to the global financial system, well, this is why we own gold.
You know, folks, I say this all the time. We are living through history, but most people are too distracted by their phone screens, by AI headlines, or by Jim Cramer yelling into a camera to see it. And I've got to tell you, when you look at what's happening right now in gold and silver, triple-digit silver isn't crazy at all. Not even close. In fact, I'd argue it's inevitable. Now, I'm not here to make wild claims for shock value. I'm here to lay out the evidence. And when you throw in the shortages, when you throw in the demand from big money, when you throw in the demand from BRICS nations stacking physical reserves, you realize that this isn't a fringe theory. It's happening in front of our eyes. Let's start with gold, because silver hasn't yet caught the fire that gold has. But if you look at the past 6 months, gold is telling a story so loud and clear, it's deafening, unless, of course, you're the mainstream financial media who apparently need hearing aids. The S&P 500 has just had one of the strongest rallies in history. Over the last 5 months, it's up nearly 1,700 points. NVIDIA, AI, all the tech darlings. This is the biggest tech story since the internet, and yet gold quietly outperformed it. That's right, gold is up 37% in that same period. The S&P just 9%. Gold's return is 4 times greater in the middle of the most hyped stock rally of our lifetime. But nobody talks about it. CNBC? Silent. Fox Business? Crickets? Jim Cramer? He's still telling people to buy NVIDIA at the top while gold quietly trounces the index he worships. I remember when gold broke through $400 an ounce years ago. I couldn't believe it. And if you had told me then that we'd be sitting at futures around $3,700 today with no media coverage, I would have laughed you out of the room. But here we are. Since 2023, gold is up 100%. The S&P is up 67%. That's great for equities, sure. But gold has quietly been the better trade. That's not me saying it, that's math. And this isn't happening in a vacuum. The insiders, the biggest money in the world, understand it. Here's the setup. Public investors are more all in on stocks than at any other time in history. Not just invested, leveraged. Margin debt is at record highs, over $1 trillion. Options exposure, record highs. Stock allocations, record highs, higher than 1929, higher than the dot-com bubble, higher than 2008. The public is leveraged to the gills in the most expensive stock market in history. And at the exact same time, insiders are dumping equities at a 7-to-1 clip. That means for every dollar they put into stocks, they're taking 7 out. Where do you think that money's going? I'll give you a hint. Every single month, we see billions and billions of dollars worth of deliveries standing on the COMEX. The biggest money in the United States is walking away from paper promises and standing for physical metal. So the public is all in on stocks, margin, and options. The insiders are quietly heading for the exits and piling into gold. And what does the media talk about? Taylor Swift tickets. Now let's pause here with a bit of humor. I saw a meme the other day. When gold hits $5,000, CNBC will finally air a segment on why gold is a bad investment. And isn't that the truth? They'll tell you to buy after it's already doubled. But let's step outside the US for a minute, because this story is global. Just this month, Poland's central bank announced plans to increase its gold holdings to 30% of reserves. Think about that. 30%. That's not a hedge anymore. That's a statement. Adam Glapiński, the head of Poland's central bank, said it plainly. In these difficult times of global turmoil and the search for a new financial order, gold is the only safe investment for state reserves. That's not a gold bug on Twitter. That's a central banker in an official statement. And it gets better. Glapiński reminded us why they hold gold. Because if someone cuts the power to the global financial system, which, let's face it, is all digital accounting records, gold still holds value. He literally said, "Fortune favors the prepared." Folks, this is the governor of a central bank spelling out exactly why physical gold matters. If the digital system goes down, if the banking network seizes up, if cyber attacks hit the wires, your digital balance means nothing. Gold doesn't blink.
There's no question that something bigger is happening. I mean, there is no question about that, right? And a lot of it focuses on the LBMA. I'm going to try and make this part a little bit easier to understand. It's somewhat complicated for people who don't understand the lingo. I'll try to make it as easy as possible. First of all, when you look at gold, speculators are returning into the gold market. We can see that on COMEX with open interest rising again. That means open interest is the amount of interest, and people are interested in buying the metal. Open interest is rising, and prices are breaking out of this consolidation range. We see it bust out again. That's the normal link between purchasing and higher prices, right? But in silver, what we're seeing is something different. The rally is being driven not by speculators, but what seems to me by some form of a short squeeze. Because you have record high lease rates in London to lease the gold. That would be the same thing if you wanted to short a stock. There's a cost to borrow the stock from an entity that then allows you to short it. A stock is something, if you short something or naked short something you don't have, you have to borrow the stock first and then short it. Same thing here. You have record high lease rates with silver in London, anywhere between 5 and 6.5%. Normally, those lease rates are somewhere around 1% or a fraction of a percent. Even in times of stress, they barely get above 1%. Right now, they're between 5.5% and 6%. I'll talk more about that in a minute. But you also have falling open interest, meaning the demand by the speculators is falling with heavy delivery demand. So far, 58 million ounces have been delivered since late August. Almost 11,000 tons have been delivered year to date. This points to shrinking physical liquidity and mounting pressure on the market. In other words, these short positions are struggling to get the metal to cover their positions. As the lease rates go higher, the people who own it are like, nah, we're not going to give it away 5 or 6%, which is way higher than it ever is. With everyone standing for delivery, this is a problem. And when we talk about what's happening on the LBMA, recent data shows about 600 million ounces of silver are traded every day in London. There's about between 1 and 2 billion ounces of paper claims on meaning they could stand for delivery, between 1 and 2 billion ounces, yet the official available free float is only 140 million ounces. So in other words, if there's 1 to 2 billion ounces of claims against 140 million ounces available to be delivered, and a lot of that is already locked up and not truly liquid, what could possibly go wrong? In other words, London has virtually no free silver to meet these rising investor demands or to back the billions of ounces in outstanding contracts. This is getting interesting. And at the same time, you see the COMEX flush with metal. All of that metal, I remember I screaming, this is not about tariffs. And all of that metal that's come back to the United States has put I believe the U.S. banks on solid footing. Normally when the U.S. bank shorts COMEX, they go long delivery contract in London to offset. Well, they've brought all that metal back, and you could argue to put their book in order. These European banks are facing an existential threat. With lease rates and prices spiking, the risk of a delivery default in London is rising. And, this is the chain reaction that you would talk about.
Now let's keep this train moving, because part 1 set the stage. We talked about insiders dumping stocks, central banks hoarding gold, and the fact that gold has been outperforming equities even during the AI boom. But here's where it gets even more dangerous and more interesting. The United States is caught in what I've been calling the debt trap. It's like quicksand. The more we try to pull ourselves out with rate hikes or spending cuts, the deeper we sink. And the Fed knows it. They're boxed in. Raise rates too much, and you blow up the banking system, the treasury market, and the housing market. Cut rates too soon, and you kill the dollar. Either way, the end game is debasement. That's why gold is screaming higher. Let me put this in plain English. U.S. debt just crossed $36 trillion. That's trillion with a T interest on the debt is over $1 trillion a year, bigger than the defense budget. And here's the kicker. A third of that debt has to be refinanced in the next 2 years. Do you think they're going to refinance at lower rates? No way. That's like trying to roll over your credit card at a higher APR. It's unpayable. The treasury market is the backbone of the global financial system, and yet it's becoming untradeable in size. I once worked as counsel to a primary dealer. I can tell you firsthand, these markets aren't bottomless. You try to sell $1 trillion of T-bills in a day and watch what happens. They'll shut it down. Now combine that with the fact that stablecoins, money market funds, shadow banking products, basically unregulated dollar substitutes, are all piled into treasuries. It's a giant Jenga tower. Remember what happened in 2008 when money market funds broke the buck? The Fed had to bail them out. It's the same setup today, except bigger, leveraged, and more fragile. And while all this is happening, what do you see on CNBC? Headlines about how consumer spending is resilient and how soft landings are possible. Folks, that's not analysis. That's gaslighting. Meanwhile, the insiders are moving their wealth into gold and silver, the BRICS are building a parallel financial system, and the public is all in on stocks at valuations higher than 1929. You couldn't script a crazier disconnect if you tried. Let's talk about BRICS for a minute. The bloc has been quietly buying gold at record pace. China, Russia, India, Turkey, Kazakhstan. These guys aren't buying treasuries. They're buying metal. Why? Because they understand the fragility of the dollar system. The dollar has been weaponized. Sanctions against Russia woke the world up. If your reserves are in dollars, they can be frozen. If they're in gold, no one can touch them. That's why central banks are stockpiling it like their lives depend on it, because in many cases they do. Here's an example that flew under the radar. Back in August, a Russian economist tweeted this: "If the West thinks sanctions crippled Russia, wait until BRICS launches a settlement system backed by gold. The dollar's days as unquestioned reserve currency are over." Now, whether you agree or not, the sentiment is spreading. More and more countries are looking for ways to transact without the dollar. Gold is the bridge. It's neutral, it doesn't care about politics, and it's the only asset with 5,000 years of trust built in. Now back to silver, because silver is the sleeping giant. Industrial demand is going parabolic. Solar panels, EVs, 5G infrastructure, they all need silver, and not just a little bit. We're talking about record tonnage every single year. According to the Silver Institute, demand for industrial silver in 2024 hit an all-time high. And yet mine supply is stagnant. We're in a structural deficit. That means we're using more silver than we're producing for the third straight year. That doesn't happen in commodities without fireworks down the road. So on one side, you've got industrial demand exploding. On the other, you've got investment demand ready to ignite once silver breaks out technically. And in the middle, you've got dwindling inventories. The COMEX registered category is at multi-year lows. The LBMA vaults are bleeding. India imported record silver last year. Mexico, the world's largest producer, is seeing declining output. This is the setup for a supply squeeze like we've never seen. Now, I want to pause and tell you something that made me laugh. Someone sent me a screenshot of a CNBC article with the headline, "Gold's Rally Surprises Analysts, Silver Still Lagging." The meme caption underneath said, translation, "We missed it. Please don't buy now so our friends can load up first." And honestly, that's how it feels. By the time the media acknowledges silver, it'll already be $75 or $100. Retail will chase at the top while the insiders are already sitting on their stacks. But don't just take my word for it. Look at what happened in 1980. Silver ran to $50 an ounce when gold was $850. That's about a 17-to-1 ratio. Today, gold is around $3,700 and silver's in the mid-40s. Do the math. If we even approach that ratio again, you're talking $200 silver. That's why I keep saying triple digits aren't crazy. History already proved it can happen. Now let's zoom back out. Why is all of this happening? Because the financial system is losing credibility. The Fed is trapped, the Treasury market is cracking, and inflation is eroding trust in fiat currencies. People aren't stupid. They might be late to the game, but they aren't blind. That's why you're seeing billionaires quietly buy farmland, art, real estate, and yes, precious metals. They know paper promises are only as good as the trust backing them, and that trust is fading. I'll give you a little anecdote. I was at a conference recently, and a gentleman who manages over $5 billion in family office money pulled me aside. He said, "Andy, we don't buy gold because we want to. We buy gold because we have to. We don't trust the system anymore." That's the sentiment at the top. The wealthiest, most connected people in the world aren't buying meme stocks. They're buying ounces. And yet, here's the irony. The average American owns 0 precious metals. 0. They might have a gold chain, maybe a silver spoon, but no bullion. Instead, they've got 401ks stuffed with overvalued equities and debt-based assets. They've got exposure to a system that insiders are quietly abandoning. It's like being the last person left at the poker table when the sharks have already cashed out. Now let me add another piece of this puzzle. Geopolitics. We're living in a multipolar world now. The US isn't the only game in town. China is building trade networks, Russia is weaponizing energy, the Middle East is flexing its influence, and Latin America is joining the conversation. In this environment, gold isn't just a hedge, it's a weapon. It's a tool of sovereignty. That's why countries are racing to accumulate it. Because in a fractured world, trust is scarce, and gold is the ultimate trust anchor. I want to bring in another quote, this one from Zoltan Pozsar, the former Credit Suisse strategist who's become kind of a cult figure in macro circles. He wrote in a note last year, "We are witnessing the birth of a new Bretton Woods, except this time the anchor is commodities, not dollars. Gold will play a central role." Think about that. A new Bretton Woods, a reset. If the dollar loses its absolute dominance, if trade starts settling in gold or gold-linked instruments, what do you think happens to the price of gold? What happens to silver, the smaller, thinner, market-riding shotgun? You don't need a PhD in economics to figure that one out. Now let me lighten the mood for a second. I saw a tweet from @GoldBugGrandpa that said, "Watching CNBC ignore gold's rally while pumping AI stocks is like watching your neighbor mow the lawn while their house is on fire." That's exactly right. The financial press is mowing the lawn, pretending everything's normal, while the system smolders. So where does this leave us? It leaves us at a crossroads.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.